In this video, we're going to kind of move ahead with our discussion on the Infosys valuation, and we're going to try and now make projections for the coming year. Right? We've already projected some of the drivers for the P&L and the balance sheet. And now all that is left is basically an understanding on what is going to be the projection for the coming year, right? Based on that, we're going to find out what is going to be the numbers for next year and try and build a completely linked model in this video, right? So let's first zero down and try and understand what are going to be my assumptions. My first assumption is going to be what is the net employee addition for this year, right? And we'll mark these assumptions in a certain color, maybe a light green kind of a thing, on what's going to be the assumption, right? That's my first assumption that's going to be there. If I have this number as 20,000, I know what is the year-end number of employees, right? The second assumption is on average, what is going to be my number of sales and support guys? This is important because I need to remove these people in my calculation of the utilization of employees. My third assumption is going to be the utilization rate, right? Once we make an assumption for this, we should be able to find out what is the number of people who have been billed. The number of hours is a constant, so that necessarily does not need to be looked at as an assumption. The fourth assumption is the growth in the billing rate. And the fifth assumption would be my INR USD rate. If I can get these numbers, these five assumptions, I should be able to project the revenue of the company. Let's take an example. Let's assume the company adds 15,000 employees in the coming year, right? Let's say the company adds 15,000 employees in the coming year. So that would give me a total number of employees as 19044 plus the net addition. I can try and do a gross minus attrition calculation as well, but that's secondary to the nature of the entire thing. Let's assume 5% of my workforce, because last 4 years average is about 5%. 5% of my workforce is sales and support. What is my average number of employees? I can just drag the formula and that gives me the average number of employees for that year. This number is going to be 5% into the average number of employees. That's the sales and support guys I will need, right? I can take 5%. I can also take it the same as last year as 4.9%. As the organization becomes bigger, you don't need the same number of sales and support guys. So probably this number will go down further, right? Let's assume for the time being that utilization rates are 75% only, same as the last year. 75%, I can assume it to be the same as last year. What that would mean is the number of employees who are getting billed, I can just copy the formula here. I can just drag this formula here, right? Number of hours billed is going to be 2000. So 1,43,714 employees getting billed for 2000 hours a year at a certain billing rate. Let's assume the billing rate does not move in dollar terms, right? In fact, it might even be a negative 1% in dollar terms. Why negative? Because the company might be willing to do it purely because the rupee dollar rate that we are assuming could be 67. During this year, if we look at the average INR USD rate during this particular year, it must be close to 67. So what is the billing rate per hour? Can I calculate the billing rate per hour? That's 36 into 1 plus whatever is the change, correct? 36 into 1 plus whatever is the change. So in dollar terms, the billing rate goes down. What happens in rupee terms, right? In rupee terms, the billing rate should be the multiplication of these two. 67 multiplied by 35.6, and that's my rupee billing rate, 2388 rupees per hour. What is my revenue? My revenue is a function of the number of employees who are getting billed into the number of hours they are getting billed during the year into the billing rate per hour and divided by 10 raised to 7 to convert it to crores. And that's my expected revenue for this year in rupee terms. So basically, by putting in the assumptions for growth in billing rates, average INR USD rate, utilization reported, sales and support, and the number of employees that are added, we arrive at the revenue number for this year. Right? Simple. That's my revenue projection. We have not really debated the numbers this far. We will come and check those numbers again, the assumptions number. But all we need to do now is change those assumptions number and the numbers will may move accordingly. Right? We now move ahead to what other assumptions are needed. So on the cost front, average employee salary change is needed. Then we need all these assumptions as to what these headers would be as a percentage of costs. And we need a effective tax rate assumption as well. So let's assume that employee salary continues to change by 5%. What that means is this year, the employee salary on average would be 19 lakhs 52,000, right? Let's also assume that the ones where we had a sense of numbers being stable, which is the everything else other than technical subcontractors, I'm going to take an average of the last 5 years, right? For all these 5. We can debate it later, but that's broadly the number. And because there is an increasing trend here, I'm going to assume a slight increase here. We'll again check and find out as to why this increase is happening, but that's the broader trend we are working with. These are all, remember, percentage of sales, right? Can I find salary cost? Number of employees on average during the year, that's 2 lakh employees multiplied by average salary cost per employee divided by 10 raised to 7. That's my salary cost for the year. Everything else is 6% or a percentage of the revenue of that year, and the revenue number is here, right? And that's all we need to do. Multiply each of these percentages we just assumed with the revenue for the year, and those are all my cost headers available. That basically projects all the costs. So I can go to the P&L, look at the projection area, and link the revenue of the year here. That's my revenue. I can leave other income for the time being. Just ignore other income for the time being. We'll come back to that later on. Let's go to the assumption sheet again and link all the cost headers as well. And we get this data. What that does is it should give us an idea about what's the operating profit of the company. We need to find out what depreciation would be. We'll do that in a minute. For the time being, I can just drag this as well because that's a formula as well. And I can take an assumption on the tax rate for the company. Let's assume the tax rate is 28%, which seems to be the average of the last few years. So as of now, without the depreciation number in, I can calculate the broad taxation that comes in here, right? And that's about 4,700 odd crore. That gives us the number for tax and final profit number as well, right? We don't know if the numbers are correct. We don't know if we have projected them correctly, but what we do know is they seem to be linked correctly now. All we need to do now is the gray cells or the green cells change and the assumptions change and everything works fine. We then move to our assumptions on the balance sheet front. So first let's do some capex calculations, right? Do we know the year-end number of employees now? That's this. The moment we do this calculation, that means that there are 15,000 employees added. For each employee, the company, let's say, adds 10 lakh rupees as capex. That means 1,500 crore would be needed as capex on account of new employees. About 1266 would be needed on account of depreciation. That's 2766. What that means is my gross assets for this year would be last year gross long-term assets plus the capex this year. So that's 23436, right? Can I make an assumption on the depreciation number? So what is the assumption here? This is the assumption here. Everything else is coming from other sheets. And I can make an assumption for depreciation. Let's assume depreciation is 6% of my gross fixed assets. So 6% into my gross fixed assets for the year, that's 1406. That's my depreciation number. Once I have this depreciation number, I can find out accumulated depreciation for the year as a total. So that's 8896. And the difference of these two will give me the net fixed assets for the year, right? So my net fixed assets is 14,540. Remember, this is tangible plus intangible put together. So again, just two sets of assumptions is what we have taken here, and that gives us the overall data in terms of what's going to be my net fixed assets for this year. Let's also go to the assumption sheet and make an assumption in terms of what's going to be my assumption here on the number of days sales outstanding as receivables. So I assume this could be the same as an average of, let's say, the last 5 years. And maybe because we see a trend change, we look at it over 5 years or 4 years. Let's take 4. And 4 because these numbers are looking in line for the last 4 years. The previous year was out of ordinary. This seems to have increased over the last 3 years. So I'm going to take only an average of the last 3 years here, right? Remember, this is number of days sales outstanding. If I multiply this with basically my revenue per day, or I divide this by 365 and multiply with the revenue, that should give me my receivables, right? 66 days worth of sales, 64 days worth of sales. How do I find that? I can find my receivables as 64 days multiplied by sales per day. What is sales per day? What's my revenue? This divided by 365, correct? And in this equation, I just need to freeze the row, but not the column. So we get our receivables number as 12,111. That's my loans and advances number. And I can just copy this and paste that number here. And we'll get the number as the current liabilities numbers. Therein, we have projected broadly the working capital drivers as well. So we have projected CapEx, we projected assumptions for working capital. We are now ready to put in the numbers on the balance sheet. In the P&L, one number was missing. That was the depreciation number. I can link the depreciation to my CapEx schedule. I've calculated it as 1406. That comes here, right? We will look at whether this number is correct or not in a few moments. But for now, this is fine in terms of putting in the numbers linkages, right? On the balance sheet this year, let's assume the share capital remains the same. We don't have a news if Infosys is going to give a bonus or something of that sort. Last year reserves plus the profit of this year is going to give me the reserves for this year. Remember, we were keeping debt constant. This number was 0. Current liabilities we just projected. We just projected the current liabilities number on the assumption sheet. That's 18,443. So we get the total size of the liabilities balance sheet as 87652, right? Net assets, we now have a combination of these two, right? So I'll merge the cells on the CapEx schedule. My net fixed assets is 14,540. That's the number. This is the sum of these two now. Let's keep capital work in progress constant. Remember, capital work in progress is any building you are constructing but has not finished as on that date. If you want, you can add this to the CapEx and then put this number as 0. It's a cash neutral transaction, so that's absolutely fine. It doesn't really change anything in the cash flows of the company, right? We can do that. Let's assume this 960 crore is now constructed, which basically means on my CapEx schedule, I will just assume my gross fixed assets to include on my balance sheet this 960, right? Once I do that, numbers change a little bit, but in my assumptions on the balance sheet, this number then becomes 0. I don't need anything here. This is completed now, right? I'll keep 3 of these numbers constant for the time being. And in terms of my current investments, let's assume current investments remains the same because that's cash equivalent. Receivables is available on the balance sheet and loans and advances is available on the balance sheet, right? So if is available on the assumption sheet. So that gives me these numbers. I can calculate what the current assets are as of now, total of those, and we can get the sum of everything here in terms of what is the data available for us in our overall calculations, right? This obviously includes this set of data. And our balance sheet will not balance at this point of time because we have not really calculated what's the cash flow impact. So let's now turn our attention to the cash flow. This number is going to come in here and we're going to build in this number. And on the cash flow, which is the FCFE, let's start building the cash flow now. How do you build the cash flow? You start with the net profit, right? We start with the net profit and you add the depreciation. And one of the reasons why depreciation rates are not that important in valuation is because you anyway add it back. You're going to value this cash flow, right? You subtract any capital expenditure that the company has done. You subtract, in fact, before you subtract the capital expenditure, you subtract change in net working capital. Why is this subtracted? Is because if receivables have gone up, you have not received that cash. That's an assumption, right? So you change that while you arrive at the FCFE. And you look at any net changes to debt and you add that, right? So this is to be added, right? We don't consider dividends here because dividends don't matter. You're assuming this is the capacity of the company to pay dividend. So that's your free cash flow to equity. That's broadly the free cash flow to equity. I can begin with an opening cash number and I can end with a closing cash and bank balances number. Last year closing number is available with us, right? On the balance sheet, last year closing was 32697. That number is available with us. I can actually select this entire set and format the entire data. What was last year closing cash is going to be this year opening cash, right? Let's plug in the numbers. Where is my P&L profit? That's here, 11,215. What's my depreciation? That's again on the P&L, 1464. Change in net working capital we haven't calculated as yet. So how do I calculate that? On the balance sheet, I have to find out all the non-cash current assets. I have to find out current liabilities and the subtraction, which is if this is A and this is B, then A minus B is what is going to be my working capital, right? Working capital. Once we put this in, so what is the non-cash current assets? That's my receivables plus loans and advances plus other current assets, if there was any such number. Current liabilities, everything is available. That's 6902. The difference between these two is my working capital. And I can just drag this ahead till this year. And what is change in working capital? So what is the change in working capital? Let's just put the font size as the same. The change in working capital is this year number minus the last year number. And we drag it back. And again, we kind of format it. Let's format it. Let's increase the font size. That's my change in working capital that I find. I can just link it here in my FCFE straight away. What's the change in working capital? Balance sheet minus 33. That comes here. Capital expenditure available on the CapEx schedule. Total capital expenditure 2766. Changes to debt. There is no assumption here. So I can just go here. This minus the previous year. Just in case we change that assumption, gives me the debt. Let's add 11,215 plus depreciation minus change in net working capital minus capex plus any changes to debt. That gives me the total cash flow. Year ending cash flow is the sum of these two. That gives us the total ending cash balances for the company. And if we have done everything correctly, then this number once plugged into the balance sheet should mean that the balance sheet balances. So I go to the balance sheet, I look at the cash number, cash and bank balances. We link into the final ending cash and bank balances. And let's see, we have this row called check. It matches. Total assets 87,611, total liabilities 87,611. We now have a fully linked model with a certain set of assumptions that we have created, right? What are the assumptions? All the assumptions on the P&L are marked in the green color. All the assumptions on the capex schedule are marked in the green color, and that's broadly it. On the balance sheet, we made a few assumptions. If we want, we can mark those as well. So the debt was an assumption, and these numbers were an assumption, and my capital work in progress is an assumption, right? And current investment is an assumption. That can honestly be added to cash and kept it there as well, right? We have a fully balanced balance sheet. We have the cash flow for the year. We have the data that we need for this year. All we need now is to project the formula in the future, and we should get our data for the next few years as well. If we do that, we should be able to have a balanced balance sheet in each of the years. Once we have a balanced balance sheet in each of the years, we will get the P&L numbers, cash flow numbers for subsequent years. Once we have all those numbers, we can then move our attention towards basically going ahead and finding out what the discount rate for Infosys should be and discount the cash flows to arrive at the final valuation. That's it in this particular video. Thank you.